Welcome to the number one show and the source of truth for all things MedTech. Here, we reveal the secrets and stories behind the investments, science, and commercialization of the MedTech industry. Every week, we'll take you on a wild ride with the biggest names in the game, from entrepreneurs and investors who are shaking up the market to healthcare providers who are revolutionizing the way we think and practice medicine. So hold on tight and get ready for a journey like no other. This is the State of MedTech. Hey everybody, welcome back to the show. So another venture capital episode. I'm very excited for this one. And before we get into it, I just want to remind you all, especially for the founders out there, the number one premier MedTech summit that you have to be at is LSI. That's Life Science Intelligence Emerging MedTech Summit. LSI USA just happened. I was honored to be a sponsor there. LSI Barcelona is around the corner. It's happening September 18th to the 22nd at the Ritz-Carlton Barcelona. It is a beautiful venue, an amazing list of investors, amazing list of innovators. You have to be there. And compared to previous years, LSI has become the must attend. It's not a nice to attend, it's a must attend conference. And so the speaking spots might be gone by this point, but you might be able to get a ticket to attend in person. If you're an investor, you got to be there. If you're an innovator, a medtech startup or CEO, you have to attend, right? If you can't get a speaking slot, grab a ticket, attend the event. It is probably the most worthwhile time that you'll spend in any medtech event. So be sure to check it out. If you just Google LSI Barcelona, you'll see their page right away. Now, today's episode is venture capital episode. And, when you look at the, economy, right, and sort of the macroeconomics that are happening globally, there's a lot of uncertainties, and medtech venture capital funding has been anything but static. I mean, we just saw NuVasive and Globus agree to a merger, a $3.1 billion merger. There's been a lot of money getting poured into different exciting medtech companies like Moon Surgical. Moon Surgical just raised another $50 million with NVIDIA and J&J leading the round. So a lot of exciting things going on, right? And we're witnessing just an explosion of investments, which is going to transform the landscape and supercharge innovations that promise to redefine the future of healthcare. If you look at some of the most powerful companies on planet Earth, Microsoft, Amazon, Apple, Google, when these companies who are tasked by their investors to grow every year are looking for something to grow, they can't just go into some random sector, right? They're all now looking into healthcare. Okay, it's truly an exciting time, and there's a lot of groundbreaking startups with, AI. Generative AI has been a big thing. Machine learning, of course, digital medicine and biotech. It's attracting billions of dollars and creating an unparalleled impact on human wellness. And so, who better to guide us through this extremely exciting time than a seasoned industry veteran and venture veteran, and that's Paul LaViolette. Paul LaViolette is the managing partner and COO over at SV Health Ventures. He has over 35 years of global medtech management experience. He joined SV in 2009 as a venture partner, and very quickly in 2011 was made partner. And he was promoted to managing partner and COO in 2014 and heads up the medical device investments. Now, prior to that, he served in a variety of different medtech operating roles. More notably was that he was the COO over at Boston Scientific, which, if you've been living under a rock, is a $8 billion company. And during his 15 years at Boston Sci, he served as COO, president, group president for the cardiovascular group, group president for endosurgery, president of cardiology, president international, as the company grew over 20 times, and he integrated 24 acquisitions and led a lot of product development. So it's rare, in my opinion, to find somebody with this kind of a background, who is a seasoned investor in the medtech space, but also has such an impressive operating background. So Paul's somebody who I've always admired and deeply respected, having met him through LSI. And so I was very excited to finally get him on the show. The funny backstory was I had finished my panel on surgical robotics at LSI. Paul's panel was right behind me, and so while we were, making the changes to the panels and everything, I was stepping off stage. I went over and quickly introduced myself and told him, "Hey, I'd really like to have you on my show," and he agreed. I'm glad we finally made it happen. So before we get into it, though, I want to give a quick word to one of my partners and new sponsors, which is Clary. If you're a medtech founder, CEO, VP of sales, and especially if you're an investor, Clary is the kind of company that you're going to want all of your portfolio companies to be using. So Clary, the way that I like to put it is that it essentially takes your investment in Salesforce and turns into something that is going to actually run revenue. Entering data into the CRM is a time suck for everybody. There's so much data that doesn't even make it in there because sales reps are just so busy. And if you think about it at a startup level, they're even more busy, right? There's not a lot of structure. And so a lot of companies, they get Salesforce because you need it. And then this huge investment is made, and you don't get any clarity on it. And especially if you're a VC, you want to know. Well, you want to have some predictability when it comes to your revenue, right? And so the sales reps don't have the information they need to close deals. Sales leaders don't have the information they need to run their business. And the VCs who are attending the quarterly board meetings are given bad data and direction. So Clary bolts onto Salesforce and turns it into gold. I really mean that. So they're the leader in revenue operations and intelligence. They've built a category around revenue, collaboration, governance, and essentially enables organizations to put Clary onto Salesforce, pull in the activity, the insights, automate all of this, and more importantly, allow you to predict revenue, and then figure out if we're going to hit 5, 10, 15, 50, $100 million for the year, for the quarter. What's the route to getting there? Are we doing it? Do we have deals in place? How do we manage the pipeline, right? And so they made such a huge impact as a result of that. I wanted to partner up with them. So they're actually my first official partner because they are very much aligned with the vision that I have for this industry in terms of how do we elevate it with a powerful tech partner. So that being said, whether you're a VC or a CEO or a VP of sales, maybe you're even a sales manager, I highly recommend you check out Clary. You can go to clary.com or do me a favor. This will help the show because we like to track our analytics. Click the link in the show notes below. Go check out Clary. Learn what they do for the life science and medtech industry. They have a whole division dedicated to medical devices and medtech, and get their revenue analysis. I recommend just booking the demo. Even if you're not a fit yet to use them, you'll learn a lot. So go check them out. That's CACLARI.com, Clary.com. And trust me, you'll thank me later. And finally, if you are a medtech leader, you're a startup founder, you're trying to get traction, we all know whether it's trying to attract investors at scale, customers at scale, or grow pipeline, it's best to do that all at once. Here at the State of MedTech, we like to work with founders. And so if you need help with generating some leads, driving awareness, right, growing that traction and designing that category, I want you to reach out and talk to us. One of the best success stories I always like to point to is Moon Surgical was our very first client well over a year ago. Ann Ostowit, the CEO, and I worked very closely together along with their chief strategy officer, Jeffrey Alvarez. We focused on how do we do this through social media and how do we do it through content, right? And since then, they raised a $30 million Series A last year in the spring, then most recently a $55.4 million round where names like NVIDIA and J&J were involved in leading the round. Former Intuitive founder Fred Moll joined the board. And so a lot of these things, they start with the ability to tell a compelling story to the market, to the investors, and to your customers, right? And here at the State of MedTech, we like to do that. So if you're interested, please reach out to me, check the show notes below, and book time with me. We'd love to show you what we can do for you. So with that being said, here's our episode with Paul LaViolette. Enjoy. All right, everybody, welcome back to the show. I have a very special guest with me here. We ran into each other at LSI. I actually ended my panel on surgical robotics and introduced his. And in between that time, I was made sure to go over and chat with him, just say, hey, I've been wanting to get you on the show for a while. And that's Paul LaViolette of SV Health Investors. Paul, thank you so much for coming on the show. How are you doing?
Hey, Omar. First of all, you're totally welcome. I'm doing great and delighted to spend some time with you today.
Absolutely. Absolutely. And, before we just kind of jump into things, man, I got to tell you, Scott Pantel and the LSI team, every year, I always say, I'm like, you know what, there's no way they can top last year. And they always did. How did you like the show?
Well, I don't think of it as a show. I think of it as a conference, a meeting.
As a conference, really, yes. We're on a show. We're talking about a conference, yes.
It's important. I think the best way to describe it is that it has become important. I started to spend more time, ironically, at LSI giving some talks, even when the conference was virtual. Now that we're all back and the normal flow of travel has increased, it's really a vital meeting, I believe. We attend it, our firm attends it, more than one individual. We look forward to a really packed schedule of meetings. It's a really vital interaction scene for MedTech. And I'm really glad LSI is doing what they're doing. Scott's done a great job.
Absolutely. And one last thing I'll say on it is just, I always judge conferences, events, companies, individuals in the industry based on this one question, which is, would I miss it if it disappeared tomorrow? And LSI, I think I would miss it dearly. If anything, I almost credit LSI for almost bringing me back in the industry, because I went into software for about a year, and when I was trying to decide what to do next, LSI played a big role in that. So a big shout out to Scott and their team. I mean, fantastic job. I know they have their LSI Europe is going to be happening in Barcelona later this fall. I'm already getting FOMO because I didn't go to London last year because I had a baby, and this year, even my wife was like, "Oh, you should really go to Barcelona." So I might just find a way to just make my way over there.
No, it's a fantastic location for a meeting, and I agree with you. It is a meeting that we would miss, and I think to be blunt, I think LSI has displaced JP Morgan as a must-attend meeting to kick off a new calendar year with early stage medtech activity.
I completely agree. In fact, last year and this year, JP Morgan went by and I didn't even notice it. And I remember I always talk to people. I'm like, oh yeah, JP Morgan happened. How'd that go? So before we we have a lot of great topics that I want to cover, including, the investment thesis you have over at SV Health, your advice to VCs and medtech founders. But, you have a phenomenal and very deep and rich history in this great industry. How exactly did you get started in it? And, what was your ascension, up to SV Health?
Well, I got started honestly by accident. I think about this somewhat humorously over time when I interview individuals who want to get into investing, want to get into medtech, and they tell me about how their parents were physicians and their grandparents were physicians and their uncles were hospital presidents, and they've grown up with nothing on their mind other than being in the medical technology space. Honestly, I have an undergraduate degree in psychology, went to business school. Between my first and second years of business school, I got an internship at a medical product company. I enjoyed it. They called me back during the second year and asked me to do some intern projects, and did that. Midway through my second year in graduate school, they hired me full time, and I've never looked back. That was a company called Kendall at the time. Kendall, now part of Medtronic, spent 4 years there. Entry level stuff, market analyst, product management. Then went to CR Bard when Bard was an early leader in interventional procedures and at that time interventional cardiology. Spent 9 years there, going up through the ranks, ultimately becoming a young general manager, division president. And then I was called by a recruiter that was looking to place the position of president of international for Boston Scientific. And I basically said at that time, I've never heard of Boston Scientific. So it was an early stage company at that time. I joined. I was responsible for all the businesses of Boston in all countries outside the US. Then we did some mergers. We restructured. I became a group president over a couple of divisions. And then that tenure lasted 15 years. At one time or another, I ran all of the divisions separately or as part of a group: endosurgery, cardiovascular, was president of cardiology. Sometimes I was president of a couple things at the same time. Then I became chief operating officer over all of the divisions, all the operations, everything from R&D to supply chain to every sales force. And it was a remarkable experience, 15 total years. And after joining when I hadn't heard of the company, I left, and it was an $8 billion company. Retired at the ripe old age of 50 something,
Amazing.
and was looking for something to do next. But I think I used all my, for the most part, my operating gas
I know the feeling.
on the first day of the year. Yeah.
It's amazing. And so what exactly attracted you to medtech investing? I'm going to quote Jay Watkins, because so Jay Watkins over at Sonder Health, or not Sonder Health, Sonder Capital, I'm sorry. When he was on panel, he said it, I'm paraphrasing here, but he said, yeah, he's like, medtech investing, it's really, really hard. It's brutal. He's like, but I love it. So what attracted you into the venture world of medtech, and why SV Health?
Well, Jay is fantastic, and he's right. I don't think about things as whether they're easy or hard. I just presume that in life, my role is to carry a big burden and suffer. And so I love to work hard no matter at what. And obviously, I'm a medtech lifer, right? And so we play a really important role in an ecosystem. I say that because part of what makes you driven at a certain age and a certain stage of life, it has to be the mission. I think investing is all about filling unmet needs to me. And given the ecosystem that we're in, so much capital being spent, maybe unnecessarily on healthcare, so much inequity, so many untreated patients, so many unfilled needs that innovation can play a role in. It's really great fun to be really focused on innovation. I think if you break down all the functions of a company, and if you run companies and then say, okay, if I had a choice and I could define a role and I could extract from the role and keep those things that I like doing, and I could put aside and not pay attention to those things that maybe I don't like doing as much. I think investing in early stage companies really includes a lot of the things that are really fun to do. Doesn't mean it's easy, doesn't mean you'll be successful all the time, but it is really rewarding because you can take a technology from, as we say, bench to bedside. You can ultimately try to drive a new therapy through to becoming a gold standard in the care pathway. And when you ultimately see a technology that you invested in make it through the gauntlet to market and then being used routinely in patients, that complete cycle is really what it's all about. Major corporations do that routinely. Then they have to maintain their business, and there's a tremendous amount of energy that goes into maintaining business. I think what we're doing here is trying to add as much value as we can to the innovation front end of the industry. And then we hand our technologies off to somebody else to build the companies. But that's really where we focus. And I think it's tremendously rewarding.
And that was one thing. That's why I want to have you on the show. Is I kind of noticed that with the type of investments that SV Health makes, and again, you mentioned doing it on the front end. Why is that? And the reason why I ask is that what I'm, at least in my anecdotal experience right now, what I've noticed is that a lot of investors, when I speak to them about different companies and everything, their response usually is something like, "Hey, we love investing in startups, but we're really looking for growth companies that are doing 5, 10, 15 million in run rate per year, et cetera, et cetera." I'm like, well, that's not really exactly venture capital. Because I mean, if a company's doing 15 or 20 million in revenue already, like, it doesn't take a whole lot of sophistication to say, hey, maybe I should put some money into that. Why is it that you guys focus so much on the front end? Because there's a lot of risk involved. It's very painful. It's heartbreaking sometimes. Why is that?
Well, first of all, we do the latter stage investing as well, without a doubt. I would acknowledge what folks tell you, and we have a fund that does nothing but that. And it is call it whatever you want, late stage venture, early stage growth, growth equity. There is value to be created there.
Hmm.
There are returns to be generated there. Obviously, if all the money goes late, there are two problems. One is that there won't be any early stage assets. And two is that there's too much money chasing too few assets that get to that late stage, which will drive up valuations, which will worsen the likelihood of a high return. So it's not automatically safe just to go late. You still have to go late and generate a venture-like return.
Hmm.
And so if everyone goes late, that by definition turns it off from being a safe harbor, if you will, for investment. We like early, I would say, if there's a single word that describes the potential benefit, it's ownership. If you go late stage and you write a $20 million check, but the company is already de-risked and has revenue ramp, has a defined business model, has customer demand, the valuation on that is going to be relatively high, and the $20 million you invest may buy you a relatively small piece of that company. It will grow. Maybe it has a public offering in its future. There are plenty of ways to grow your valuation at that point, but you have to get in at the right point. And if you get into the right company, the right story, wonderful growth potential. But if you get into too high a valuation, you may have a great ride, but end up with a poor multiple. So it's not automatic to go late. To go early, you can, of course, you invite by definition incremental risks. You're taking some other risk, but you're also likely getting larger ownership. And if you can get in with a large ownership position early and enter into a story, a company, an investment thesis that won't take 10 years and has the potential to exit not all the way through the stages through to late commercialization, but perhaps earlier, then you can have higher ownership at a favorable valuation that isn't diluted through the fullest extent of all investment rounds, has an exit and returns the highest multiple possible. So our job as investors is to try to generate returns, highest multiple in the shortest amount of time. And if we can do that in early stage investing, and there is upside potential there, then that remains a very viable place to put capital.
Got it. Now that makes a lot of sense. Now, in the world of like investing in finance, most companies, especially in the VC stage, they're not Excel spreadsheet companies yet. They're PowerPoint companies, right? And so part of this is that I'm sure, especially having been through your career in medtech, and now you've been in VC for a while. I actually have a very nice volume of editions of Nassim Nicholas Taleb's books over on my bookshelf here. He talks a lot about the use of heuristics, like little shortcuts for you to make decisions in life. When you're looking at a company, just yourself, Paul, what are some heuristics? What are some signals that when you identify them, you say, oh, you know what? These are some things that are good indicators of a company worth investing in. Do you have such a rule set that you use? Like what do you look at?
Well, there are at least a couple of things. Number one, I don't know how to order these, but certainly the unmet clinical need. At some point, this has to be an idea, as we like to call it, a big idea. What's the big idea behind the investment? This has to be an idea that is going to solve a significant problem. It's going to draw a lot of attention. In today's medtech world, that significant problem has to be a combination. It's like a composite endpoint of some element of clinical efficacy and cost reduction, not even cost effectiveness, but cost reduction, cost elimination. So you start with that as a premise. The second, I would say, would be a highly sensible, common sense mechanism, which is to say, if we were developing a drug and we were going after a cellular mechanism, we would want to know that there is science in place that says if we do this to that cell, to this cellular function, then the following thing will happen. We know that. Now the trick is in delivering that action. I think in the medtech value proposition, you have to have a sense that a technology can be brought together that is likely to succeed. It may have technology development requirements. It may have miniaturization. There's certainly going to be work to do, but you have to be able to look at that and say, yes, it's likely to be technically achievable. I think the third element, not in order of priority, is management team. In the end, there are lots of good stories. As they say, small percent is vision, or small percent is strategy. Most everything is execution. It comes down to management, ultimately driving great progress on both as little capital as possible, but also with as few missteps as possible. And that comes from some combination of real intelligent insight and hard-earned experience. And then I think the last element is that if you took everything I just said and then mapped out a Gantt chart, a gated progression of technology, and said that no matter what we do, it's going to take 3 or 4 rounds of preclinical experimentation, and then it's going to take 3 rounds of human experimentation to generate evidence, and then it's going to require the longest possible lead time, through the FDA with a PMA panel track, and then it's going to go into a category that doesn't have reimbursement. You say, okay, no matter what we do, this is going to be years and years and years and years. And so that's a non-starter, even if you have the other elements. Don't pick that much of a gauntlet. So I think ultimately having a roadmap that allows through whatever degree of clinical and regulatory and reimbursement complexity you're inviting upon yourself, there has to be a reasonably efficient roadmap so that you can stack those elements and end up delivering an exitable thesis in a reasonable amount of time. I'd say those are the 4 wise man rules to live by. And then, of course, each one you're trying to judge as you meet companies, look at technologies, conduct diligence. You're constantly trying to figure out, am I onto something here? Is this right or is this wrong? Of course, every one of these can still fail along the way. You're just trying to reduce the likelihood of one of those failures or 2 of those failure points. You're also trying to reduce the likelihood that even if you succeed at everything, that by the time you get there, it has taken so long that there's no there's no juice left in the squeeze. So that's how I would look at it.
Got it. Has there ever been a situation where it sounds like the most important of those 4 that you mentioned was the number 1, which is the unmet clinical need? Would you agree with that, or would you weigh something else over that?
It's hard to say. I personally, I think long-term seasoned investors would probably say management. Now, I say that recognizing that sometimes our early stage companies go through management changes because early stage entrepreneurs or founders may not be the right people to take their companies all the way through to the next or 3rd or 4th stage. So management sometimes changes, and that seems to undermine the notion that, well, you're investing in a management team. How can you invest in a management team and then change the management team? So management ultimately will have the highest likelihood of determining your success. That doesn't mean the exact same manager or managers will be on the project, but quality management at each stage is probably most important. And I say that because you may come to me as an entrepreneur with an idea, to your point about option number 1, curtain number 1, and you say, well, the unmet need is very large, and that's obvious right from the start. That may be true, but it may not be addressable. We may not ultimately get there. So just having a big target to shoot at, it's ultimately necessary to make sure that your target isn't really small. But if your target isn't small and it is somewhere in the middle, a good management team likely will find new ways to expand that target. And if you look at ultimately creating addressable market value, great management teams will expand their addressable market one way or another. So I would still say in the end, having a great management team wins out. They can fix problems. If you have a technology limitation, if you end up with a reimbursement setback, no matter what you come up with that could deflate your returns potential, a great management team can find a way to overcome that.
Yeah, no, I completely agree. My late mentor, Chris Sales, who was early class and intuitive, always gave me that advice, which is, at the end of the day, you can always have a great technology, but there's a lot of great technologies that fail. You got to find like the people who can take it to market and make it realized. I'm gonna put you in a tough spot here. And so here's the scenario. When it comes to management, CEO is obviously very important. Let's say that you're evaluating a medtech startup that fits a lot of the criteria you just mentioned, and let's just assume that they received FDA clearance. So let's say 510(k) clearance. Okay. After the CEO, your bias, who do you first look at on the management team to make sure, like, if this person in this role isn't the right person, then I have concerns. Do you have a bias to one function over another, and why?
No, but I do have a bias to one function. So the real question is, given one situation versus the next, it's the board and management's job to figure out what their critical pinch points are. And so even if you're going commercial, you might look at that and say, okay, our number one job is to have a great chief commercial officer because now we're going into execution mode. Well, that may be true if everything is necessary for that commercial team to sell. But you may have supply chain issues. You may have gaps in your evidence, and you may end up with a great sales force that can't penetrate into the purchasing barriers because they don't have the right material. You may have a failure in positioning because you have a great product, but it just doesn't align with that market fit, and that may require shrewd marketing to help reposition the company. So the real question is, can you look at the ingredients and say, I think I have the winning elements here, but I have to unleash the value by dialing something up. There's something here that's not right or something here that's not complete. What is that? That's the area that will, if we do it well, unleash the most value. And if we don't do it well, we'll determine that we will stick in the mud. And I think that's the job of governance, be it the CEO or the board or both. And then you go ahead and determine, okay, then we better put all our eggs on the chief clinical officer, chief commercial officer, chief operations officer, whatever that is, because that will then be determinative of your success. But it's never going to be the same person in any two stories. It entirely depends upon the opportunity you're going for and the basket of ingredients that you've been given to figure out and ultimately turn into a recipe.
Interesting. Yeah, and as I'm talking to you, it sounds like one of the keys to being successful in the world of like venture capital is that, when you're dealing with such high stakes and like, really big swings of emotion, like whether a company has a big exit or fails, it seems like from case to case, you really have to do a good job of managing your own biases and realizing that they're there so that you don't, fall victim to them and more leverage them. Is that correct?
That's absolutely correct. First of all, everybody has bias. We're all biased. That's not a bad thing. You have to realize what those biases are. You may be biased in the right direction, right? So you may not want to limit your bias. You may want to leverage your bias and say, you know what? The 3 or 4 successes I've had as an entrepreneur, all 3 of those ended up having a similar pattern. And if you're really good at recognizing that pattern, then the best thing you could possibly do is try to find a new opportunity that represents the same kind of pattern, where your same bias, your same approach, you can go ahead and do it again and run that same playbook. So it's okay to be biased. It's not okay to be biased and to not realize it. Mm-hmm. That if you do that, then you're constantly going to be trying to fix a situation to fit your desires, but it may not be the fix that the situation calls for. So to address that, Omar, I think the way we like to look at things is to recognize we're not, we're smart people, but we're not the only smart people in the room, that it's really great to have diverse opinions. We often invest with at least one other or several other firms so that we have more than one set of experienced eyes and ears around the table. We don't have the assumption that we're the owners of all the right ideas, right? So no matter whether you're the associate program manager or the chairman of the board, you should assume that your as they say, you were born with two ears and one mouth, and you should use them in that proportion. So I think it's always listen, work hard, gather the facts, bounce it off people, get new ideas, just make sure you're doing the right thing, because no one, I don't care if you're as I am, 44 years into this business or 4 years in, if you don't do the homework and don't reduce risk with questions and hard earned answers, then you're not doing anything to reduce the probability of failure. And if you're not doing that, then you're not going to be a good investor.
Right. No, I completely agree. Could you share an experience where, an investment that you had made faced some really difficult times? Like what were those difficult times? What'd you do to help correct that?
Well, I've had a number, certainly, that have had difficult times. So it really it depends. It depends, and this goes all the way back.
What was the most
Quite
painful
frankly,
one?
well, any painful one is one where you just don't make it, right. If you have a company that fails and just cannot get there, then you always want to do it's a retrospective analysis. Why did it fail? What could we have done differently at the time, based on what we could have known? And was there anything that we could have done differently? And this is maybe one of the most frustrating things, is that maybe the only way to have avoided that would have been to just simply not do the investment. What could we have taken away from a diligence process, more, I say, rigor to balance out against the optimism of a new deal, all the positives that come when you're onto a new technology, you're onto a new team, you're onto a new opportunity. There's so much positivity around that. It's really important at that time to, with some experience, think about, okay, we've seen good ideas before. We've taken some 2 years, 4 years, 6 years down the clinical, the regulatory, maybe even the marketing path, and yet they don't all succeed. So what is it that I can look for today? And guess what? As a venture investor, we look at 98 out of 100 deals and pass on them and only do one or two. So it's okay to find reasons to pass. And I think with experience, what I've learned is that there are things to look for right up front that maybe, to your question, Omar, if you did the investment and you rolled the clock forward a year or two, you would encounter a problem. And maybe you could come over that with experience. But that's a setback. And that takes time and money. And that leaves time for competition to pass you by. So the real question is, how do you look at a new technology, a new opportunity, and understand that it has really the most streamlined pathway through, that it's not likely to have major hiccups and setbacks, and that you can honestly map a reasonable pathway to completion and to some kind of a return. And that's a really, really hard algorithm for most companies to pass. And that's why we should be, unfortunately, really liberal in turning ideas down. And the ones that you turn down are going to possess a lot of good factors. And you have to realize that, even when many of the factors are positive, if there is one thing that looks like it could be a snag, and that snag could cost you a year or two, and as you sit there today, you can't figure out how you're going to solve it or avoid it, you know what? That's a reason to pass, even if everything else looks like it's all green lighted.
Are there any factors when you look at a deal that, maybe, again, like there's no deal that's perfect, right? They're always going to have something. Are there certain factors when you look at them where you say, this is not perfect, but we can work through that. We can, that can take some time. What would those things be usually?
Well, exactly. If you may not have the definitive form factor, right? You may have worked on prototypes. You may have done first in human clinical experience with the non-finished product. But there's an example where you say, okay, we know the product today is too big. It's unwieldy. It's not elegant. But is there anything about that process of converting the prototype or the clinical use device into a finished price, a product, a finished MVP product at least? Is there anything there that requires breakthrough innovation or new technology? If it's all about execution, then you can look at that and say, okay, if we get the right people with the right time and money, and we don't want to do that for 5 years, but if we get the right people with the right time and money, and that project is 9 months or 12 months, we know the resources, we know the path, this kind of thing has been done before, then you can look at that and say, yeah, that's a risk that we can take on, but we're going to be able to check that box. And what you want to avoid is a risk that, contrary to that, is one that is not clear in how it will be solved. And it may be a reimbursement problem where you say, well, there's a high economic demand. Patients want this, clinicians want it, payers would benefit from it, but there's no way to get all those together into a streamlined approach, or it's going to take 3 or 4 years. And in many instances in medtech, obviously, we get to that valley post FDA, pre some form of coverage decision, and those are the ones that are the hardest to solve. And when you're making the investment or looking at the investment, you can look 3 or 4 years down the road, and you can confirm at that earlier date that the problem you're addressing or you're faced with in that early discussion, it will not be solved. You're going to have to solve it then, and you're not going to know more about how to solve it then than you know today. Then you're just inviting really an unsolvable problem into your value proposition, and that's something that you probably shouldn't do. And I would say 9 times out of 10, unless there's a completely new business model, that in our world, reimbursement generally becomes that factor. Most anybody can solve a technical problem. There are training problems, there are clinical challenges, there are execution challenges, but for the most part, those can be overcome. I'd say the ones that end up being most elusive are coverage and payment issues.
Yeah, and it's funny you mentioned it. Our good friend Henry Peck actually had a really good post on LinkedIn the other day about this topic, and he had one of the better analogies I've seen in a long time, which was he said that getting FDA approval is kind of winning the first battle, but figuring out reimbursement is really the war that you got to win. And for me at least. In my career, like I'm a disruptive, emerging med tech guy. I know nothing else. I guess I just like to suffer. I don't know. But for me, I worked with a lot of robotics companies where for a long time we didn't have any reimbursement, nothing set up. How do you weigh that when it comes to, especially like if you look at digital medicine, right? A lot of things that don't have reimbursement set up right away, but you can see that it's going to be clinical efficacious, it's going to reduce costs and everything, but you don't have reimbursement. How do you factor that into your investment thesis, and how do you account for that? If everything looks good, but it's like we don't have a reimbursement pathway yet, we're figuring that out. Like it must give you some pause, but how do you work through that?
It definitely gives pause, and I would say if that is the case, then you have to surround that problem with enough positive drivers that are so compelling.
What are those positive drivers?
And well, the drivers. So, as an example, we have one company called Zarigo, which is it's an alternative for treating chronic skin conditions such as psoriasis and eczema. It's an alternative to biologics. Now, biologics are effective. They're easy. They're extraordinarily expensive.
Very expensive, yeah.
In a young patient, that might be a $50,000 per year expense forever. And that kind of specialty pharma expense is really raising problems with payers. They desperately want to avoid that. So it is in the desperation and the magnitude of that expense that you create an opportunity. You never want to say if we build it, they will come. But if the ability to disrupt cost is that clear, and if the cost that you can disrupt is that large, then you can start to assume, all right, there are ways for us to build a business model around that because the numbers are so big, the motivations are so clear, the interests are so aligned that, and the market is large. So you know what, we don't have to get that large a market here, such that we can get going. We can then generate real world evidence of our value proposition. And that real world evidence of a value proposition goes to payer then after payer after payer. And they start to see, wow, these are real numbers. They've occurred in this payment model, this payment model. If I adopt it here, I'll save money for my company. So there are ways to do it, but it takes an unusually strong alignment of factors if the one straight path that you want, which is straight into a existing code with an existing payment level, if you don't have that, then you have to have much stronger kind of pathways, circumnavigating pathways around that. If you have no direct pathway and only a moderately attractive circumnavigating pathway, then you're likely inviting a reimbursement problem that may just be too big to take on.
Yeah, no, I completely agree. On the technology adoption is one of the topics that's very important for me. When you're evaluating deals, how do you view adoption? Because usually when a company's early stage, right, they're going to be at as far left as you can be on the adoption curve. They're dealing with like technology enthusiasts, not even early adopters yet. And so obviously when you talk to a technology enthusiast, let's say in a case of a surgeon, right, they're going to be, everything's great. This thing is amazing. It's so vision, everything, and so it's easy to get caught up in that excitement and hype. How do you go about figuring out, does this technology have legs for true adoption? One thing that I feel like is a good heuristic these days is that because of social media like LinkedIn and Twitter, physicians are starting to post, especially early in new technologies, like their usage of a new tech, their experiences with it. But outside of that, I mean, how do you go about, because again, it's kind of like it's very biased, right? It's kind of like when I interview people and they give me references, nobody in that reference is going to be like, yeah, they're actually not that good. Like nobody's going to say that. It's the same thing with companies. Like, oh, we'll let you talk to one of our top users. Everything's going to be great. How do you get around that?
Well, I think the first thing to do is to just assume that adoption, and you're absolutely right to raise this point. The adoption rate is probably the single most difficult variable in the entire value equation of a technology to nail. We can probably figure out what the clinical success will be if it's a clinical study. If the clinical success is going to be a little bit lower, we can power the study a little bit larger and overcome that. There are a lot of ways to deal with everything in the pre-commercial world to get a product to that launching pad. Adoption not only is hard to judge, but I would also say it's become intensely more challenging based on everything we know about today, which are in the form of adoption barriers, whether it's value analysis committees at hospitals or contracting norms, you name it. There are many business processes that are either intentionally or unintentionally constructed for the purpose of slowing down technology adoption. And it is because there is a presumption that new technologies drive costs up. So while we're battling that process, that mindset, what's really important is to do really a map of adoption barriers and to understand that by no means is it sufficient to have a surgeon sitting in front of you at the hospital with a cup of coffee after he's done his last procedure and you've just shown him your technology and have him fawning all over it and saying, this is fantastic. If I had that tomorrow, I would use it. Okay, take that and ascribe it to be 0.5% valuable in the larger algorithm of how we're going to map and project adoption. Then you look at all of the other factors that have to be overcome, whether it's a capital equipment purchase, as you describe robotics, if you think about training and learning curve, if you think about contracted barriers in the form of strategics that are there before you and you're a new company. There are so many things that get in the way that you really have to build a balanced equation, both of the probability of overcoming the barrier and the time sink associated with each. And then at the very end is your pot of gold in the form of adoption and first, utilization. But that could be 18 months after that surgeon first tells you that they're in love with your product.
Right, right. One of the things that in my opinion, how much money you take is as important as who you take the money from. And there's a lot of, and again, this is just my personal opinion. There's some medtech VCs where, in my opinion, and I call them medtech VCs, it's a very loose term for them. Some investors that there's people with a checkbook. That's my opinion. And on the other side of that, there are people like you that, aside from providing that investment, a CEO, founder can go to Apollo Violette and get some very solid guidance on, operations, marketing, sales, these kind of things. How do you look at structuring a board, like for a founder? Because sometimes, again, my personal thought on this is that sometimes I see founders where they immediately fill up a board with the wrong people, or let's say in the case of a tech enthusiast, it's great to have that first adopter. That's not usually the person you should give, an advisory seat to or something, because they might be great that first year, but then 3, 4, 5 years down the line, you're stuck with this person, right? How do you view that, right? And it's kind of a complex question, but it's something that I always think of when I look at startups.
Your last point is a really good one. That there are multiple layers of advisory capacity that a CEO can build around his or her company, and you see them often, whether it's scientific advisory boards, clinical and business advisors, and those can all be effective and completely unrelated to the board of directors. So recognize the board for what it is, and use it for that, and don't conflate the role of other advisory capacities, which are potentially equally important, but simply not the same. Number one. Number two, entrepreneurs do need to raise capital, and their number one concern is to assure that their company is properly capitalized. And so sometimes you get to select both the investor and the check. Sometimes you have to take the check and don't get to really select the investor. And there's no binary outcome there. It's graduated. You may get the best of all worlds. You may get the worst of all worlds. But there are a lot of ways to sort, I guess. Of course, every venture group, every investment team has a portfolio, has a reputation. You can do a lot of homework. I think the way, if I were to advise a CEO, it's to do as much diligence on your prospective investors as they're doing on you. When it comes to sorting through the ones that you ultimately prioritize, and as a founder, as an entrepreneur, I may have two term sheets on the table, and one may be for the better valuation and more capital and 17 tranches available for the next 12 years. But I may actually be better off taking capital from another group that offers me a better overall blend of value drivers. And so the founder and entrepreneur is in an interesting position at that point. Once you're up and running, if you're a board, you've got fiduciary responsibilities, it's very difficult to not take the deal that looks best on the table. And it's very difficult to take one that is worse quantitatively for difficult to measure qualitative reasons. However, the one time and the one person who can actually make that judgment on his or her own accord is the founder, entrepreneur, raising capital early on when they still own a controlling interest in the company, and they're making a decision really for themselves. And if they dilute themselves more and take more costly capital, but from the right investor, that's the right choice to make. So I would look at it and just say, don't chase the best deal, chase the best outcome, and just weigh all those factors and do it more earlier on, where it's easier to actually make those trade-offs. And it's harder to do that later when you have 1, 2 rounds of investors at the table. And now you can't just say, you know what, I want to go with that one, even though their capital is more costly, because now you're not only diluting yourself a little bit more, but you're asking other investors to dilute themselves, and they're less likely to do that. So it's a really important point. You build the board by way of building investors, and you only have so much influence in selecting investors. Later stage companies, if they're on a great roll, they have a great value proposition, they have multiple investors chasing them, great. That's a really good problem to have. You can select. But that doesn't happen in the majority of cases. In the majority of cases, you work hard, you finance aggressively, you get 1 or 2 term sheets, maybe only one is acceptable. So you have to realize the time to really shape things is earlier on, because once you get a late stage term sheet and your company's off and running, you may not have that many choices, and it's too late to then think about how do I construct things.
Interesting. And so it sounds like your advice is just essentially that earlier on is going to be the most important decision because later on things are kind of in motion. They have momentum. They're a little bit more difficult to change and everything. And so it's almost like starting a company or I guess even a family, which is sort of the culture and tone you set early on is going to really dictate everything else moving forward. Would you agree with that?
Yes. And now listen, if you're lucky and you work hard and you execute well and the early choices you make are favorable, then you do the right things. And then by the time you get to Series B or Series C, it may well be that you're doing so well, you continue to have favorable choices. But you won't, but you can't guarantee that. The only time you can guarantee that you'll have real trade-off flexibility is earlier on.
Got it. Got it. So, right now, being 2023, there's a lot of interesting changes like in the market with AI, robotics. I can name all these buzzwords. What are some of your investment theses as a firm and yourself in terms of the areas of medtech you're really looking hard at? You feel like is going to be the future. What kind of things do you guys get most excited about and most interested in? Because
Well,
I think people have been people have been sorry. I was going to say I think people have been burned in the past with. I mean, digital health is a kind of a great example. I mean, digital health is still great, but like I think a lot of investors got burned, between 2015 and 2019 by a lot of digital health investments, right? Not saying that digital health is bad, but like now with all these changes post-pandemic, there's so many things that have changed in the market with the regulatory side. I mean, we can have a whole conversation about Silicon Valley Bank and First Republic. All these changes, what are you guys most drawn to? What are your theses?
Well, I feel when challenging times occur as we're in, you really resort and return to the fundamentals. You're still looking for what I described earlier: very strong unmet clinical needs, very strong potential value proposition, very strong management team. It takes exceptionalism on multiple touch points in a company to make it through very difficult times when capital is not available, or when macro factors are trending into headwinds. It's at that time that you say, okay, well, this is the time to really be exceedingly committed to the fundamentals, doing that much more homework. It does make it more difficult to raise capital because your filter pool is smaller, but that's from an investor perspective. That's how we would think about it. Part of that is driven by difficult times creates capital uncertainty. Capital uncertainty creates a focus on portfolio management and capital preservation in your companies, maybe increasing your conservatism as it relates to reserve. That means you may not want to be as rapid in deployment of capital into new companies. So all of those things work to kind of slow the engine down, both at a fund, but also in the marketplace. They do that for a reason. It's called pragmatism. And that makes it harder to raise capital, but it makes it safer to manage capital and manage companies without necessarily increasing your risk of loss because the environment is tough.
Right. It makes sense. And again, for me, I love seeing like very early stage venture, but at the same time, like every VC has, a group of LPs that they're beholden to, and they need to be very responsible and disciplined about how they deploy that capital. I saw something the other day where it said that, it wasn't necessarily medtech, it was mainly in the, so like SaaS got a massive inflection of investment during, I think, 2019, 2020. And that dried up. And, the saying going around is that a lot of the venture-backed CEOs of these SaaS companies, they're going to go through and understand what it means to be a wartime CEO right now, right? Because VCs are very pragmatic about where they're investing. Do you feel like that's kind of the strategy? Maybe it's a sort of a collective unconscious thing where it's like, hey, right now there's too much risk in the market. We're going to hold on to our investments for now, and let's see who makes it out the other end and how well they do. And at that point, there'll be a good, rather than placing your bets on a few companies, you reduce the odds. And it's like, well, these out of these 20 we were looking at considering, these 5 made it out the other end very strong and better. Let's double our investment in those ones. Is that the right way to look at it?
It is, and you said it may be unconscious. It is absolutely conscious. It is absolutely the way investors change their mindset and start thinking out loud and discussing in their investment committee activities. I would say it is not just the investor. It is the entire ecosystem. So at the same time, investors are looking at those market factors. Well, so too are the CEOs of the top 10 med tech companies, right? They're looking at valuations that may have come down. They're looking at their own cost of capital going up. They're looking at the uncertainty associated with revenues in 2020, 21, 22. Not sure as they'd like to be, not as comfortable as they'd like to be about 23 and 24. We're now seeing, by the way, lots of really strong earnings reports over the last month. So first quarter 23 has been very strong, but given the macro uncertainty they faced, they are going a little slower on pulling that trigger for a 500 million or $2 billion acquisition. And that trickles down. So investors have to do the same way. And that ultimately affects the rate at which company formation takes place.
That makes, that makes a lot of sense, because technically I never thought of it like that, but that's actually very, that makes complete sense, which is, as an investor, you're investing in a company with the hope that either they're going to go private or get acquired, or go public and get acquired. And you can essentially guess, actually, now you just gave me a heuristic of my own, which is, if I want to know what the venture capital community is kind of thinking about doing, I just need to look at the quarterly earnings of the largest companies in medtech and then decide, okay, nobody's really making these big transformative acquisitions or XYZ, then that's what I should expect from the VC community for the next 3 to 4 quarters.
Yeah, I think there's a little bit of a delay, right, in terms of push on one end and how quickly it comes out the other. But basically, no one is immune. Now, certain companies certainly continue to perform well, and if you're a $15 billion top line company that has $3 billion of cash on the balance sheet, you're probably not going to stop in your tracks because the Fed raised the interest rates by a quarter point. That you have to think long term, and frankly, that may create opportunism because you've got financial power and the rest of the market is slowed and more cautious, and there are fewer buyers and therefore less auction pressure on assets that you want to buy. So everything works its way out, but generally speaking, the ends of the markets are connected to each other.
Right.
They don't move in 1-to-1 ratio, but they move in a with high correlation.
That makes sense. I guess that's why I think it was Charlie Munger who said it's like when people are greedy, be fearful, but when people are fearful, be greedy. So,
well, yes, at least it forces you to think, and so if people are fearful, the real question is why. And if you believe that you simply do not have the same reasons to be fearful, then sure, become opportunistic at that point. I don't like the word greed ever, but it may be appropriate at that time to move aggressively and
say opportunistic.
And be opportunistic based on market factors. Absolutely.
One of the things that I don't know why, I don't know if there's a reason for this or not, but in the venture capital community, the idea of mentorship is it seems to be really important. But when you were sort of developing your career as an investor, were there or are there investors that you admire a lot, you respect a lot, who have some of those people, how did you study those people?
Well, investors are more and this is not intended to be pejorative, but investors tend to be more lone wolves than let's say open book mentors. And that's not to cast aspersions on any one individual. They're great people in venture. But
you're right. That's why I find it interesting.
Well, in a corporate life, everyone knows, okay, it's our job as managers to mentor those below, and that talent development is just part of the company culture. Once you become an investor, you're thinking about applying your mentorship capacity to your CEOs. You're thinking about, okay, my audience now is not some other venture investor someplace. My audience are the people that I've put my time commitment, my LP's money, my money into, and my job is now to make that company successful by making that team successful. So if I have X time per day to put into people, I want to put it into my portfolio or into my partnership. And so I think the answer to your question really is about it's about the team. When I think about SV, having joined SV in 2009, and thinking about, and many of the partners that were there then are still here. That's the partnership that you're joining. That's the mentorship that you're looking for. Even though I was a relatively high profile executive at the time, I didn't know anything about being a venture capitalist. And frankly, even at that time, I wasn't sure I wanted to be one. And so the partnership here at SV recognized that. They recognized that most people with 20,000 direct employees don't transition to become investors. They don't scale that down. They don't scale down that effectively. And so it's a transition, and not all transitions go well. They embraced that with me and really mentored me. And so I would say I sought my mentorship within our partnership, within the folks around the table who were, many of them also converted operators, but obviously with much longer investing experience and much clearer views on how to build and run a venture firm. And I was really just nothing more than a hungry student, really, at their table. And to this day, I consider myself in that same mode of I'm still learning from them. For every year I've been in venture now, I've still been twice that in operations. So I'll never catch up to their investing experience, and that's I think the definition of a really good partnership. That we have great people. They've been here doing this for a long time, have done very well, and are great individuals. And it's a privilege to invest with them.
What, if you don't mind sharing, what was the most painful thing that you learned lesson wise as an investor that actually changed you as an investor? Do you have such a moment?
Well, I think it's making a bad investment. When I say that,
yeah, that's the more obvious one. Sure. Yeah.
well, but it's, listen,
Yeah.
I think you try to learn. I try to learn, but from everything and from everyone. And the success factors of running a business are not the same as in investing. And there are a lot of folks who are absolutely phenomenal investors, and I could never touch their capabilities. And you could look at them and say, okay, that person would never be able to run a company. Well, that doesn't matter. That's behind you. So I think the most important lesson is that being a good operator, being a good leader, being a good business, profiled business professional, that's not the same as being a great investor. And so put aside that and focus on really what it takes to be a good investor. And there's nothing more poignant or telling than a bad investment where you realize, even if you realize there were some risks in it, even if you realize there were some downsides in it, you may have thought, oh, you're a strong business person. You thought you could just then lead your way out of it, right? You've seen business problems before. You can just fix things. Well, you know what? In a small company that has limited cash and disparate views around the board, you may not get the opportunity to fix it. It may run out of money, and people may say, you know what, I've decided not to chase this risky investment with more capital. So you have to realize that the two worlds of operating businesses and investing are not the same. The factors that will make you good in one aren't necessarily the same. And you really just have to continuously remind yourself that, all right, being a good operator can help, but it's not a substitute for the fundamentals of investing.
It's actually really good advice, and it actually explains this one figure. I came across it a while back, where at least in the software and tech world, the investors who had the highest success rate, largest returns, so on and so forth, all of them were non-operators, non-technical founders. And I think maybe one of the benefits to that is that as an operator, you can't help but have certain biases that you lean on and heuristics. And maybe even though you're an investor, you bring those biases and heuristics into investing, and they're two completely different worlds. And I think that makes a lot of sense, because I think the more that you depart from those biases, the more you're able to look at everything with really, really fresh eyes, a lot of alertness and attention to detail, and more willingness to question things and then find those mistakes early on, versus, again, like, wanting something because you have a specific operating bias and then realizing that was blinding you to some other things that were lacking in a company.
I think that's right. Now, I think it also is true for investors, right? Because even an investor, as they build up their own record of companies, will pick up biases, maybe not from an operating world, but from an investing world. And the past doesn't predict the future, I guess, is the message. And a great prior company from a prior fund may have elements of similarity to the next company you're looking at, but their times have changed. And so the things that made you successful with an investment 5 years ago may not apply to what you have making an investment today that won't exit until 2030. So I think your comment about bias is really important. And the message is, I'm generalizing bias. It's true that as an operator, you can't bias that to be an investor. It's true that if you are a top physician, you can't necessarily bias that to being an investor. And it's true that if you were a great investor in the 1990s, that may not imply that you're guaranteed to be a great investor in the 2020s. You just always have to start with each investment and look at it freshly, and as you mentioned, with open eyes, with a blank slate, and sure, apply certain tenets of investing, but really make sure that you're not just falling prey to what you think superficially is a great idea. You just have to do your homework every single time.
Yeah, absolutely. Absolutely. And, we're wrapping up shortly, and we appreciate you spending some time with us. I have a few more questions. One is, I'm going to point out the obvious here. As an investor, I'm sure your inbox gets flooded all the time with pitches, all kinds of things. And, there's one investor that I'm close with, Bruce Cleveland, who wrote a fantastic book called Traversing the Traction Gap. He literally wrote that book because founders kept coming to him with like the wrong stage, wrong ask, and everything. He literally wrote a book where he said, if you want to get an investment from our firm, you got to read this book. Okay. So for you, what advice do you have for CEOs and founders who are looking to pitch their company, right? Not necessarily to get in front of you, but like, what are some things where you say, you got to have at least X, Y, Z? Like what's some of your advice? Because a lot of people, they're first time founders, and, they need to hear this kind of message from an investor so that they can at least be prepared when they do get that time with you, when they send something to you. What would those things be?
Well, I mentioned it a little bit earlier. We were talking about selecting investors, and I said you want to do as much homework on them almost as they would do on you in due diligence. And I would say, if I'm an investor, I am an investor sitting down with a company, and the first thing the company says is to tell me about your fund. My first thought is, why are you here if you don't already know about my fund? I know about your company. I've already looked at the deck. I've already thought about the top 10 questions I want to ask, and you don't know the portfolio companies that are in our investment holdings already. You should know that. You should know that I entered the following company at the following time. You should know how many companies in this medical sector or that medical sector we're in, because it's important for me. It's no different than if you interviewed for a job and then the manager says, do you have any questions? And you say, no, I don't have any questions. Well, who goes into an interview and doesn't have any questions? Who goes into a pitch and doesn't know really the investor audience that they're with? If you want to resonate with that investor, if you want to try to increase the probability that investor is going to be interested in you, you need to know what stage of investing they go in. You need to know that they've made money in this market before, and by definition have a propensity to want to make money in this market again. So if you don't know those things, it would be like making a cold call on a sales target and having no idea that they're, you want to sell a robot to them and you didn't know they had 28 ORs. Well, Come on, do your homework. And by the way, if you don't, this is a Darwinian process. If you don't do those things, you will simply never get funded and you will never get a chance to drive your vision and build your company. That's just what it takes. So you don't have to take advice from me, but if you don't do that kind of homework, the results will speak for themselves, and the market will just turn a deaf ear.
Yeah, I know. I think that's actually very, very solid advice. And I think if anything, that also will help a founder to understand, like, know who you're trying to get a hold of and pitch, because like you might actually get a hold of them, and if their investment thesis and portfolio doesn't, like, your company doesn't fit within it, you've just wasted a lot of time and energy getting in touch with somebody who's never going to invest in your company, no matter what they see, right?
I agree. And I think it's even a cold call, right? Somebody connects with you on LinkedIn, they send you a deck. Even in that most superficial of engagement, they can say, I noticed in your portfolio three other companies. And I think if you found those three companies interesting, you will find my company interesting. As simple a line as that indicates that you've done some homework, you've tried to put two and two together, you're finding a way to appeal to me, and I'm likely to open the deck and look at it. And listen, 99 times out of 100, the answer is no. But at least if I look at the deck and I say, this is not for me, but here's why, that's a step in the right direction for an investor who's trying to continuously fine tune, not an investor, an entrepreneur, fine tune his or her search for capital.
It's actually really good advice. If you get blown up on LinkedIn with that message, like, since you invested in these three companies, just know it might have come from this show. How much do you use? And I do have one more question before we let you, but not this question, by the way. This is the question before the question. But more and more entrepreneurs are using LinkedIn, one, to get customers, to show commercial traction, and everything. How much do you use LinkedIn, maybe in your due diligence, or just, kind of keeping your finger on the pulse of things? Do you use it much as an investor? How do you see LinkedIn?
I think LinkedIn is valuable. I think in several ways. I do think early stage companies can build a disproportionate presence, right, on LinkedIn, just with active posting. And it's not uncommon to see certainly good examples, companies already in our portfolio that are out there showing their technology, showing how they're doing first in human cases. All sorts of things get posted. And I think it's a very useful resource. I think as a diligence source, you never, I think now somebody calls you up or sends you a note, says, I'd like to meet with you. You never take that meeting or call without kind of checking out their LinkedIn profile and saying, okay, what is this person's background? How relevant might it be to what we're trying to do? So I think it's a very tight, relatively speaking, social medium for business, and that whether you're an investor or a hiring manager or a fundraising entrepreneur, LinkedIn is likely to be valuable for you. And I like to say to people say, well, how do I reach you? Like, how hard can it be? We're an investment firm. We're not trying to be hard to find, right? So yes, we have a website. You can find us that way and connect with us. Yes, we are on LinkedIn. You can find us that way and connect with us. And we're responsive to all of those vehicles. We understand that someone may not know our email address, even though it's on the website. So yeah, if you want to connect with us on LinkedIn, the first thing I'll do is say, here's my email address. Connect with me here so that I can connect my partners or connect my office, whatever. But we use LinkedIn routinely.
Fantastic. Yeah, and I'll be leaving the firm's like website in the show notes below. So my sort of last question to kind of wrap up things for you is that, the market's flush with capital. There's, aside from like your institutional investors and limited partners, there's a lot of family offices that are not normally medtech investors. I just found out in the last couple of months that there are family offices that come from the world of retail, construction, that are now listening to my show because they want to invest in medtech, because it feels good to make those kind of social good investments that have a great return, but then also do some good. They affect patient lives. What's your message to potential limited partners as to why they would bring their money and fund to SV Health, right? You have a very interesting portfolio. One of the reasons why I wanted to have you on is because, you mentioned Zerigo Health. One of the other companies that caught my eye in your portfolio was Alpheus, which uses ultrasound to diagnose brain tumors. So really interesting history and portfolio of medtech companies. What's your main reason why an LP would choose SV Health over others?
Well, and I just want to quickly correct you. Alpheus is actually using ultrasound to treat
Oh, to treat.
glioblastoma. So
Yes.
it's
Okay.
a very vexing clinical diagnosis, and one that is very obviously has disastrous outcomes over time, 100% mortality. So that's a very exciting company. Listen, SV, there are a lot of great investors, and I can't make an SV pitch here. I would simply say that SV we're a fully dedicated healthcare fund. We've been doing this for close to 30 years, so we have a very long history as investors. We like to think we're not unique, but our specialty is that we are multi-stage and multi-sector. We have biotech funds, we have growth equity funds. We invest in services and medtech. In addition to biotech, we have venture stage all the way up through crossover funds. And as I mentioned, growth equity. So having the ability to sit around the table with partners and talk about the implications of a glioblastoma therapy and what that means relative to portfolio holdings that we have in biotech in immune oncology as an example. That's value that you can't buy. I like to think also from an investment perspective. Everybody knows the U.S. healthcare system is a $3.6 trillion marketplace and set of problems. And everyone that's an investor has a hard time making generic allocation of investment capital without wanting somehow, some way to participate in the healthcare industry. It's too big to avoid, but it's too complicated to really understand. And so having
it's a great phrase. Too big to avoid, too complicated to understand. It's a great characterization. I'm gonna have to use that.
Feel free. And it's and that leads one to think about how do I find a way to invest wisely in healthcare without taking on risk of uncertainty that I, as an individual, can't possibly overcome because I'm not a healthcare professional or a professional healthcare investor. So I think, listen, SV is we have a lot of very veteran folks and a lot of experience and a lot of diversity across healthcare, both in the U.S. and in Europe. And I think that that gives us a good opportunity to succeed.
No, absolutely. And just my final thought on that as well. I mean, that's one of the things that really stood out to me many years ago when I found out about SV Health. And actually, it was through you because I had checked out one of your panels a while back at LSI, and so that's how I found out about SV Health. But what I liked was that it wasn't just med device. You guys cover biotech, you cover other areas in healthcare. And I also really appreciate how you guys sort of segment your portfolio out, on your website. So I'll leave that in the show notes. So now, we have a few minutes left. Probably one of the more fun parts of the show. We do a little rapid fire questions. These are just like fun questions, right? VCs have fun, right? They have fun. So
VCs have fun.
VCs have fun. That's, what? That's going to be the podcast you launch, Paul. VCs have fun with Paul LaViolette. I'll help manage that. I'm
generally, now, if you want to have the most fun, I'm the least likely person to have it with.
I doubt that. Okay, so you can take as long as you want to answer these questions or as short as you want. Again, I'm keeping a track on time. I know you have to hop soon. First question is, part of being a good investor is your ability to have continuing education. I mean, you're devouring a lot of information at once. So training yourself to do that is important. What is a book that you feel like you gift most often to people? Not on investing, just in general. Is there a book that you feel that you recommend more than anything else? And what is it?
I would say the answer to that is no. The last time I read a general business book was probably 1948.
It could be any book, not most general business books aren't great.
I love to read. I'm currently reading the 1619 project. It is reading for me is an individual thing. I never know what I'm going to like. And I feel the same way about other people. I'll recommend books. It's usually whatever book I'm reading. If I really love it, I'll recommend it. And then I read it, put it on the shelf, and move on. So I don't recommend books to people, generally speaking.
Okay, got it. That's the first time I show. So no book recommendation. Okay, I'll let you pass on that. Next question. If you were to give a TED Talk on a topic that people don't know you for, so obviously you can't be investing, what would you give a 10-minute TED Talk on?
I would say it would just be overcoming obstacles. I would consider myself someone who barely got out of high school, so I wasn't predestined to land where I did. A lot of hard work, a lot of stick-to-itiveness. So nobody's probably interested in that, and nobody's pathway is the same as mine. But I like to think of myself as having a little bit of grit and being really down to earth and not taking anything for granted and overcoming.
Fantastic. Last question, we'll let you go in again. Hey, thanks for coming on the show. I'm sure that my audience is going to want to have you back. But of all of MedTech, is there a specific area, specific therapeutic technology? Is there something that genuinely, I don't like to use the word excited, but has you excited, has you interested, where you say, you know what, I'm really interested to see where this goes? Anything that stands out to you?
Well, we called our latest fund the MedTech Convergence Fund because we really love the convergence of technologies. And you mentioned Alpheus, right, which is a convergence of directed ultrasound with in this case, an injectable, diagnostic marker. But having the ability to take sensors and to take cloud computing, to take energy that can be directed, whether it's ultrasound or neuromodulation. There's so much potential, and that the rate of innovation is accelerating. So what I don't like any particular one category, but I like the fact that multiple technology spaces, categories are converging and creating this catalyst effect in medtech innovation. And that is really exciting if one is interested in finding innovative breakthroughs that are just going to keep coming at a faster and faster pace. I think it bodes really well. Despite my advanced age, there will be investors doing what I'm doing 5, 10, 15, 20, 25 years from now because of that notion of catalyzed, accelerated innovation as we bring more and more technologies, smash them together, and create new therapies that can dislocate care closer to the home, disrupt the current methods of care and make them less invasive, more effective, lower cost, and drive health equity. I think all of that is super, super possible, and it's happening before our eyes.
Absolutely. And that's the first time I've heard that. And I like that category of medtech convergence. And I think it's a very interesting way to look at it. But yeah, I think that's the exciting part is that, with the software side, digital health, et cetera, a lot of med devices finding connectivity, right? There's a convergence, obviously. That's very interesting. So anyways, Paul, thank you so much for coming on the show. I'm going to leave the show notes, link to your LinkedIn and also SV Health's website on the show notes. This has been another episode of the State of MedTech. Thank you all for joining, and we'll see you all next time. Thank you for enjoying another epic episode of the State of MedTech. If you're feeling inspired and love this episode, do us a favor, hit that subscribe button and turn notifications on so you never miss an episode. And be sure to give us 5 stars and write a short review because that helps more people discover this amazing community of ours. If you're a company who has an executive that you'd like to be on the show, or perhaps you want to sponsor one of the episodes, shoot us an email at hello@khateebandco.com. Take care, and we'll see you next time.